We are currently witnessing a silent divergence in the digital asset markets. While the noise of the day-to-day price action consumes the attention of the average observer, a specific mathematical reality is hardening behind the scenes. For over 13 years, XRP has maintained its position within the top tier of global assets. Yet the distribution of its supply remains remarkably concentrated. Now, as we sit here in early 2026, the barrier to entry for what we would call the 10K club is becoming a structural wall. Most market participants view 10,000 tokens as a psychological milestone, a round number to hit before the next leg up. However, the data reveals that this isn't just a goal, it is a statistical anomaly. Out of the roughly 7.5 million active wallets on the XRP Ledger, only a tiny fraction have crossed this line. If you are holding this amount, then you are not just an investor. You are part of a demographic that is rapidly shrinking relative to the global demand. The XRP rich list shows that the number of accounts holding more than 10,000 XRP remains incredibly low. This indicates that the market update remains in the early stages, with retail participation low and whale activity rising. The significance of this low participation cannot be overstated. We often hear that it is too late to find significant value in top 5 assets, yet the wallet distribution suggests the opposite. The vast majority of the world is still looking at XRP from the outside, or worse, holding negligible amounts that will be easily shaken out during the next period of volatility. By securing a 5-figure bag, you have positioned yourself ahead of 95% of the network. This is the invisible threshold, the point where your holdings move from speculative to significant in the eyes of the ledger's architecture. 7.5 million total wallets versus 330,000 wallets with 10,000 XRP. This places 10K holders in the top 4.39%. As we move deeper into this investigation, we have to ask why this gap exists. Why, after more than a decade of existence and clear regulatory status in the United States, is the 10K club so exclusive? The answer lies in the way the supply is being absorbed by those who understand the long-term utility of the ledger. While the average person waits for a perfect entry signal, the window to join this elite group, it is closing. The numbers do not lie. You are still early, but the time to act on that advantage is disappearing as the ledger matures. To truly grasp the exclusivity of your position, you need to move beyond the surface level percentages and look at the human reality behind the ledger. You see, while the data identifies 330,000 wallets holding 10,000 XRP or more, the actual number of individuals in this category is almost certainly much smaller. Now, in the world of digital assets, power users and institutional players, they rarely consolidate their wealth into a single point of failure. Instead, they distribute their holdings across multiple addresses for security, privacy, and operational redundancy. Now, when we adjust for this multi-wallet behavior, the 10K club becomes even more of a rarefied air. Right? If the average whale or high net worth individual manages 3 to 5 wallets, then the actual number of humans holding 10,000 tokens could be closer to 100,000 than 330,000. Now, in the global population of 8 billion people, that is a fraction so small that it is almost statistically invisible. Now, this is the definition of front-running the rest of the world. If we take into account that many people own multiple wallets, the actual number of individuals who own more than 10,000 XRP is much lower than that 330,000. We are part of a very tiny elite group. This centralization of ownership, it tells us something profound about the current stage of the market cycle. We are no longer in the early adopter phase where hobbyists are the primary drivers. We have transitioned into a phase of professional accumulation. The 4.39% isn't just a number. It represents a cohort of holders who have survived years of legal uncertainty and market volatility to maintain their stake. They are the bedrock of the network. Here we have a pie chart for the XRP wallet distribution. 95.61% of the wallets hold less than 10,000 XRP, and only 4.39% hold 10,000 or more. As we analyze this distribution, a striking pattern emerges. The majority of wallets, millions of them, are holding dust, or a small retail amounts. Now these are participants who perhaps bought into the hype at the peak or are using XRP for small one-off transactions. The lack of conviction to scale their holdings into the elite bracket, right? Now by crossing the 10,000 threshold, you have moved from being a casual participant to a stakeholder in the future of global financial plumbing. Now, the gap between the haves and the have-nots on the XRP ledger, it is widening. And the data suggests that once you fall behind, it becomes exponentially harder to catch up as the price floor rises. While the 10K club remains a fortress of exclusivity, a more aggressive trend is emerging on the ledger's horizon. A massive transfer of wealth from retail hands to institutional vaults. Now this is what we would call the quiet accumulation. Throughout 2025 and into early 2026, the sentiment among retail investors has been categorized by exhaustion. Many people entered during the price spikes of previous years. They have grown wary of the consolidation phases, leading them to reduce their positions or exit the market entirely. However, the blockchain does not lie, and as retail balances have trended downwards, whale wallets have been sweeping the supply. Now, in this last 30 days, addresses holding between 100 million and 1 billion XRP have collectively absorbed over 600 million tokens. This isn't accidental. It is a coordinated effort by those with the deepest pockets to capitalize on the boredom of the masses. Now, the goal of big money is to manufacture a shakeout, convincing the average holder that the opportunity has passed so they can hoard the remaining liquid supply for themselves. Retail investors are reducing their holdings while whale balances are increasing. The theory is that institutions and big money wants us out of the game so that they can hoard the remaining supply. The concentration of the very top is quite staggering. There are currently only 508 individuals on the entire planet who hold more than 10 million XRP. Think about that number in the context of global finance. These are 508 entities that are not selling into the retail exhaustion. They are the ones providing the bid as the supply on exchanges hits the 8-year low. Now, by the start of 2026, the amount of XRP available on trading platforms has plummeted from 3.7 billion to roughly 1.6 billion. Here we have a bar chart showing the monthly balance changes. From December 2025 to January 2026, the retail wallets have down 1.2 billion XRP versus the whale wallets, which are now up 600 million XRP. The supply is moving from the weak to the stronger hands. This divergence, it creates a supply shock scenario. When retail investors sell, they often do so on public exchanges, adding to visible sell pressure. Right? When the whales buy, they frequently move those assets into cold storage or institutional ETFs, effectively removing them from the marketplace. And if you are still holding your 10,000 XRP, then you are successfully resisting a psychological warfare campaign designed to make you surrender your seat at the table. The smart money is preparing for a world where the ledger is the standard, and they are making sure that they own as much of that future as possible before the door slams shut. The concept of smart money is often thrown around as a vague catch-all for anyone with a large bankroll. But in 2026, it has taken a specific, mechanical definition on the XRP ledger. We are no longer observing speculative bets. We are witnessing the construction of an institutional vacuum. Now, unlike retail investors who buy on centralized exchanges and leave their assets in hot wallets, institutional players operate through regulated ETFs and over-the-counter OTC desks. Now, these entities are not just buying XRP, they are effectively removing it from the circulating ecosystem. Now, the scale of this drain is unprecedented. Since the launch of the spot XRP ETFs in late 2025, we have seen over 30 consecutive days of net inflows, totaling more than $1.3 billion. This relentless demand has contributed to a 45% reduction in exchange balances, with the liquid supply on trading platforms dropping from 3.9 billion to roughly 2.6 billion tokens. When an institution buys $100 million of XRP for an ETF, well, those tokens aren't traded backwards and forwards, right? They are now locked into a vault. Now, this creates a structural vacuum where the available supply for the average person is being siphoned away every single day. Now, before we go any further here, I do want to just take a second to level with you all, because we're looking at some incredible data here, and it is rather easy to get caught up in all of the excitement of supply shocks and whale accumulation. But you do have to remember that we are dealing with a highly volatile market. No matter how exclusive the 10K club is, there are no guarantees in this space. Regulations change, macro conditions shift, and the smart money can be wrong. So never put in more than you can afford to lose. And as always, do your own research. Right? This story is about the data, but your strategy should be about your own personal risk tolerance. Okay, let's return to the data. That contradiction, or concentration I should say, of the vacuum is centered around a remarkably small group of people or entities. Now, while we previously discussed the 10,000 XRP threshold as the apex whales operate on a different kind of plane entirely, right? There are currently 508 entities on planet Earth holding more than 10 million XRP. These 508 participants are the ones absorbing the hundreds of millions of tokens being shed by wary retail holders. They understand that as the ledger moves towards being a core asset for global finance, the value isn't in the price, it is in the ownership of the network's limited capacity. Here we can see the global distribution of the XRP Ledger infrastructure. Primary institution custodial hubs now active in the US, Singapore, and Zurich, supporting over 900 public nodes. This geographic and institutional spread, it proves that XRP is no longer a regional experiment. It is a global settlement layer being fortified by the world's largest financial managers. And while the general public is waiting for a headline to tell them to buy, the vacuum is already half full. By the time the mainstream arrives, they may find that the 10K club is no longer just exclusive, it is entirely out of reach. To understand the magnitude of the opportunity currently sitting on the XRP ledger, we have to look at the king of the mountain, Bitcoin. For years, Bitcoin has been the benchmark for digital scarcity. Its distribution is often cited, I guess, as the gold standard for decentralized networks. However, when you compare the wallet distribution of XRP in early 2026 to that of Bitcoin, there's a massive catch-up potential that is revealing itself. One that most retail holders and investors are completely overlooking. You see, as of January, the data shows that over 4.4 million Bitcoin wallets hold just over, or at least, 0.1 BTC. Now, at the current market rates, 0.1 BTC represents a capital commitment of roughly $22,000. Now, let's take a look at the XRP equivalent. To hold the same $22,000 of value in XRP at today's price, let's say $2.24, then you would need just under 10,000 tokens. Yet, while Bitcoin has over 4 million participants at this wealth tier, the XRP Ledger only has 330,000. XRP. Only 330,000 wallets hold the equivalent of 0.25 BTC, $22,000. Bitcoin, over 4.4 million wallets hold over or at least 0.1 BTC. The disparity is huge. This disparity is a massive signal. XRP has maintained its position as a top 5 global asset for over 13 years, surviving multiple bear markets and unprecedented legal scrutiny. Despite this longevity, its distribution is nowhere near as saturated as Bitcoin's. What this suggests is a distribution vacuum. As institutional adoption ramps up and the XRP Ledger is integrated into global liquidity hubs, there is a literal army of capital that has yet to enter the 10K club. Here is a bar chart showing the wallet concentration comparisons. 4.4 million BTC wallets with more than 0.1 BTC versus 330,000 XRP wallets with more than 10,000 XRP. XRP is 13 times less saturated at the same capital tier. If XRP were to reach a level of retail and institutional saturation similar to Bitcoin's, well, the demand for those 10,000 token slots would be astronomical. Now, we are essentially looking at a world where there are 13 people standing outside the door for every one person currently inside the 10K club. As the utility of the ledger scales, the vacuum of the demand will likely be filled not by retail lotto ticket holders or buyers, but by the same institutional forces that we are seeing dominate the Bitcoin ETFs today. Now, we aren't just holding a token here. We are holding one of the few remaining seats in a theatre that hasn't even opened its doors to the general public yet. As we progress through 2026, the market is quietly setting a trap for those who rely solely on the price action to determine the value. And while the price of XRP has remained relatively range-bound, in that $2 range and $2 level, the plumbing of the market is undergoing a radical tightening. Now, this is the liquidity trap, a scenario where the visible supply on exchanges is being drained so rapidly that the market is becoming dangerously thin. And when the next major demand spike occurs, there will be no sell wall to absorb the pressure. Now, the numbers coming off the ledger right now are staggering. According to the latest 2026 reports, XRP balances on centralized exchanges have plummeted to approximately 1.5 billion tokens. To put that into perspective, this is an 8-year low, levels that we haven't seen since the pre-bull market of 2018. During the final quarter of 2025 alone, over 2 billion XRP was pulled from trading platforms. This isn't retail selling. This is the sound of institutional vaults locking their doors. XRP ETFs are absorbing supply fast. With only 1.5 billion XRP left on exchanges and nearly $1.4 billion in cumulative inflows since launch, a supply shock is likely by early 2026. This is exactly why we have tracked these whale movements in real time within our free Discord. When billions of tokens leave the visible market, it creates a ghost order book. Retail traders see a flat price and get bored, but our community sees the institutional accumulation. This is a divergence, and it is the trap, right? It's designed to shake out those who don't understand that liquidity is being withdrawn. And if you are not watching the flow of funds, then you are trading blind. Now, you can join us via the link that's in the description to see these metrics as they happen. Here we have a line chart showing the exchange reserves versus the XRP price action. Reserves have dropped from 4 billion to 1.5 billion XRP, while the price holds steady near that $2 line. The mechanics here are simple, but lethal for the bears. Since the spot ETFs launched, they have recorded over 30 consecutive days of net inflows, totaling roughly $1.37 billion. These funds are structural buyers. They don't rely on day trading, but they just buy and they just hold in custody. Every dollar that flows into an ETF is a token that will likely never return to an exchange order book. They are approaching a mathematical inflection point where the demand from these ETFs alone could see and could soon exceed the daily liquid supply available on the open market. And when that happens, the trap snaps shut, and the price discovery will be likely violent. To many people, the idea that we are early in January 2026 sounds like a contradiction. After all, XRP has already delivered a staggering 38,000% increase since its inception. Now, in the eyes of a traditional investor, such a parabolic run would signal the end of a cycle, a time to exit, not to accumulate. But this perspective ignores the fundamental shift in the asset's role. In the previous decade, XRP was a speculative vehicle. In 2026, it has become a utility-driven financial infrastructure. Now, the current price of approximately $2.20 is being framed by experts as the ground floor for the utility era. The logic is rooted in the sheer volume of the market, right, that Ripple is targeting here. We are no longer talking about small retail remittances. We are talking about the $150 trillion cross-border payments market. And when you compare the current market capitalization of the total addressable market of global liquidity, the 38,000% gains looks like a mere warm-up lap. XRP has already done a 38,000% increase since its launch. But the current $2.24 price point is still early days if the utility of the XRP Ledger scales as expected. The scarcity of the rich list wallets means that when the true supply shock hits, there won't be enough XRP to go around. This scaling expectation is what separates the 10K club from the rest of the market. While retail traders are waiting for a moonshot based on social media hype, institutional models from firms like Standard Chartered are looking at the quantitative reality of supply and demand. Their 2026 projections of $8 per token are not based on pumps, but based on the $10 billion of projected ETF XRP inflows, and the increasing necessity of XRP as a bridge asset in a world of fragmented central bank digital currencies, CBDCs. Here is a line chart showing the historical growth versus the utility scale. 2013 to 2014, it focuses on the speculation, 38,000% ROI, while the 2025 and 2026 shifts to the utility-driven value as the XRP Ledger volume triples. If the utility of the ledger scales at the current pace, the 10,000 XRP that you hold today becomes a much larger share of the network's total liquid supply and capacity. Now, in a high utility scenario, the value is driven by the need for the liquidity, not just the desire for profit. Now, this means that as more banks and payment providers plug into the ledger, they will need to compete for the same finite supply that you have already secured. The 38,000% was the retail era. The next phase is the institutional era, and the numbers suggest that it could be even more transformative. For decades, the global financial system has relied on a ghost in the machine, SWIFT. Now, while the world moved to instant messaging and high-frequency trading, the fundamental plumbing of international bank transfers remained stuck in the 1970s, averaging 3 to 5 days for settlement and racking up fees that average nearly 7%. But as we move through 2026, the ghost is being exorcised, right? The XRP Ledger isn't just a faster alternative, it is a replacement for the entire correspondent banking model. The ambition here is not to speculate, it is to dominate. You see, Ripple CEO Brad Garlinghouse has recently projected that the XRP Ledger could capture up to 14% of global SWIFT volume within the next 5 years. To put a number on that, SWIFT handles over $150 trillion in annual transactional value. Capturing just 14% would mean that the XRP Ledger would be settling more than $21 trillion a year. At today's $2.24 price, well, that level of volume is mathematically impossible to sustain without a massive revaluation of the underlying asset or a transactional velocity that has never been seen in financial history. There are two parts to SWIFT today: messaging and liquidity. Liquidity is owned by the banks. I think less about the messaging and more about the liquidity. If you are driving all of the liquidity, it is good for XRP. So I'll say 5 years, 14%. This shift from messaging to liquidity is the key to the entire quiet accumulation narrative. It's also exactly why we built the cheekyschool.com, where the average retail investor gets destroyed by daily candles, but at Cheeky School, we teach you how to analyze these institutional plumbing mechanics, understand how a bridge currency actually moves trillions is the difference between gambling and investing. You have to access to our free courses right now over at cheekyschool.com to learn about all of these things. You know, how to stay safe within the crypto space, blockchains 101, and a few of the other chains too. Now, we want to know how these things actually work, then that's the place to be. And if you're ready for the deeper dives and understand, deeper things like smart money concepts, Elliott wave, risk management, portfolio management, then there's also some paid courses available at Cheeky School too, and I will drop a 50% off coupon code in the description down below for anyone who is curious. Here we have a bar chart showing the settlement gap. SWIFT 3 to 5 days, 6.7% in fees, versus the XRP Ledger 3 to 5 seconds and 1 cent or lower in fees. The efficiency gain is over 99%. The reality of 2026 is that 40% of the 300 plus financial institutions on RippleNet are now actively using XRP for liquidity. As these institutions move from testing to live production, the demand for XRP becomes a structural necessity. They are not buying 10,000 XRP to get rich. They are buying it to ensure that their payments don't get stuck in the legacy SWIFT trap. If you already hold your 10,000, or 10K, you are essentially squatting on the liquidity that the world's largest banks will soon need to rent or buy from the open market. As we cross the threshold of early 2026, the discussion around XRP's valuation has shifted from speculative moon math to rigorous institutional modeling. The most prominent voice in the space is Jeffrey Kendrick, the global head of digital asset research at Standard Chartered. Now, his team has laid out a base case scenario that targets $8 for XRP by the end of 2026. This isn't a target born of social media sentiment. It has a quantitative projection based on a structural mechanics of the supply absorption through the newly launched spot ETFs. The logic that is behind the $8 scenario is rooted in a simple calculation: capital versus the available inventory. And at least as of January 2026, XRP's ETFs have already attracted over $1.37 billion in net inflows without recording a single day of outflows since their debut. Now, Kendrick's model suggests that if these inflows maintain their current trajectory, reaching between $4 billion and $10 billion by year's end, the resulting buy pressure would collide with an exchange supply that has already shriveled to an 8-year low of just 1.5 billion tokens. Our $8 target for XRP reflects the transition from speculative asset to an institutional settlement layer, with ETF demand likely to exceed $5 billion annually and exchange reserves at multi-year lows. The supply-side pressure becomes the primary driver for price discovery. At a price of $8, the barrier to entry for the 10K club would move from the current $22,000 to a staggering $80,000. Now, this is the time that is running out element of our story, right? For the average retail investor, 10,000 XRP is currently attainable and is an attainable goal. At $8 though, it becomes a luxury asset reserved for high net worth individuals or demographics. Now, Standard Chartered's data is suggesting that the window to secure a top-tier position at early adopter prices is closing as the market prices in the end of the regulatory uncertainty and the beginning of the institutional dominance. You see, an $8 price target requires $10 billion of ETF inflows. This would represent a 247% increase from the current levels. This projection, it also accounts for the Bitcoin gap too, that we discussed earlier on. You see, if XRP reaches the $8 level, its market capitalization would approach the $450 billion level, finally crossing the valuation disparity that has existed for nearly a decade. Now, this revelation that is here is that the market is actually finally treating XRP as a financial commodity rather than a tech startup token. The $8 scenario, it isn't just a possibility, it is a mathematical outcome of an ecosystem where demand is scaling exponentially while liquid supply is being systematically removed from the open market. The investigation leads us to a singular, uncomfortable truth. The door to the 10K club is not merely closing, it is being locked from the inside. Throughout this journey, we have tracked the numbers, the whale movements, the institutional vacuum, but the final revelation isn't about a price target or a percentage gain. It is about the permanent stratification of the XRP ledger. Now, we are approaching the last exit, the final moment in history where a regular individual can secure a significant stake in the world's future liquidity layer using a standard paycheck. And as we look at the data in early 2026, the cost of living and the rising floor of asset prices are creating a pincer movement, right? In 2020, 10,000 XRP was a modest investment for a few $1,000s. Today, at $2.24, it requires over $22,000. If the Standard Chartered $8 scenario manifests, well, that same entry ticket would climb to $80,000. And when you compare that to the global median household income, which remains stagnant by comparison, the math dictates that a 10K club will soon be mathematically impossible for 99% of the human population to join. We are witnessing the last days of the retail era. Soon, the price of XRP will be set by institutional ODL demand and ETF inflows, not by small-scale trading. At that point, the average person will be priced out forever. The revelation is this: the whales aren't just buying because they want to sell it back to you at a higher price. They are buying because they realize that in a tokenized global economy, XRP is the land upon which the new financial system is built. Just as you cannot easily buy prime real estate in Manhattan today, you cannot easily buy or easily obtain a top 4% position on the XRP ledger tomorrow. The 508 people holding 10 million tokens aren't looking for an exit. They are looking at a permanent seat at the table of global settlement. Here is a line chart of the cost of entry. In 2020, 10,000 XRP cost you $2,000. In 2026, it cost you $22,400. At $8, it would cost you $80,000. The window is closing. This is your last exit. The quiet accumulation is ending, and the public realization is beginning. The disparity between the 4.4 million Bitcoin holders and the 330,000 XRP holders is the final gap waiting to be filled. Once the liquidity trap snaps shut and the exchange reserves hit zero, the price discovery won't wait for the hesitant. You have the data. You can see the whale footprints. Of course, you know about the scarcity. The question is no longer whether you are early. It is whether you still want to be in the club when the door finally closes. For now, you can do me a favor by hitting that like button, subscribing to the channel, and watching the video that is queued up on the screen. I will catch you all in the next one.